After reviewing 15,000 IRS audits and defending clients against the IRS, I've discovered the real patterns that trigger investigations. Today, I'm revealing the 3 hidden factors that determine whether you'll be audited, and it's not what most CPAs think. In this video, I'm breaking down exactly how the IRS chooses who to audit. You'll learn the income thresholds that instantly raise red flags, the specific deductions that trigger automatic reviews, and the hidden patterns that make you an IRS target. But first, let me show you why the standard advice about avoiding audits is actually increasing your risk. Want to know your real chances of being audited? It's not the flat 0.6% most tax professionals quote. Here's what the IRS doesn't advertise. Let me share a story of 2 business owners. Both had similar deductions, but one made $400,000, while the other made $1.2 million. The $1 million earner faced a 400% higher audit risk. Most people don't realize that crossing certain income thresholds automatically puts you in a different risk category. The fascinating part? The IRS operates like a business. They focus their resources where they'll get the biggest return. Making over $500,000 annually puts you in what I call the danger zone, where your audit risk jumps from 0.5% to over 1% instantly. The IRS's targeting strategy has evolved with their new AI systems, creating what I call wealth brackets within wealth brackets. A client making $600,000 from multiple sources faces higher scrutiny than someone making $800,000 from a single W-2. Each additional income stream multiplies your risk factor by approximately 1.5 times. Even more interesting, the time of year you file can impact your audit risk. February filers statistically face lower audit rates than October extension filers. Here's something shocking about tax deductions that most preparers won't tell you. It's not the size of your deductions that triggers audits. It's how they compare to your income. I recently reviewed 2 audit cases. One client claimed $20,000 in charitable deductions on a $50,000 income and got audited. Another claimed $100,000 in donations on a $2 million income and sailed through. Why? The IRS uses sophisticated algorithms to flag abnormal ratios. What's fascinating is that most tax software won't warn you when you're crossing these invisible threshold lines. Most people obsess over having receipts, but here's the truth. The IRS looks at patterns first, documentation second. The key isn't just having proof of your deductions. It's making sure they align with what the IRS considers normal for your income level. Each industry has its own normal deduction ratios that the IRS uses as benchmarks. A restaurant owner claiming 35% food costs might sail through, while a consultant claiming the same percentage in meals would trigger instant flags. The IRS maintains secret industry-specific databases that even most CPAs don't know about. Geographic location also plays a crucial role. The same home office deduction that's normal in San Francisco might trigger an audit in rural Kansas. Everyone knows running a business increases audit risk. But here's the truth. I help clients structure their businesses to stay under the IRS radar while claiming every legitimate deduction. Let me break this down with real numbers. If you file a Schedule C, your audit risk can jump by 300%. But here's what most CPAs miss. It's not just having a Schedule C that matters, it's specific combinations of factors. I recently helped a client reduce their audit risk by 70% just by restructuring how they reported their business income and expenses. What most people don't realize is that certain business deductions are what I call audit magnets. The secret is knowing which combinations of deductions set off IRS alarms and how to properly document the ones you do claim. The timing of when you report losses can be just as important as the amounts. first-year business losses are scrutinized differently than third-year losses, with the IRS expecting to see specific progression patterns. Vehicle expenses follow a particularly strict pattern of scrutiny, with the IRS using cell phone data and mapping technologies to verify claims. The interplay between business and personal expenses creates what I call gray zone deductions that require specific documentation strategies. Most taxpayers think unreported income only matters if it's large amounts. Here's what your tax preparer isn't telling you. The IRS can spot missing income as small as $100, and their matching system is nearly perfect. Let me tell you about two freelancers. One missed reporting a single $800 1099 miss and triggered an audit that uncovered $30,000 in issues. The other had 20 1099s but reported every penny and stayed audit-free. I've seen the IRS's matching system flag discrepancies that even expert CPAs missed. What's fascinating is that the IRS knows about your income before you even file, thanks to their information matching program. Most people don't realize that income matching isn't just about 1099s and W-2s anymore. The IRS has expanded their data collection to include payment apps, cryptocurrency exchanges, and even social media posts about your business. The IRS now uses artificial intelligence to cross-reference your lifestyle with reported income, scanning everything from property records to social media. They've developed sophisticated algorithms that can detect patterns in cash deposits across multiple bank accounts. International transactions, even small ones, are subject to special scrutiny under new information sharing agreements with foreign banks. The gig economy has created new reporting challenges, with the IRS now monitoring digital payment platforms for unreported income streams. Remember how we started by talking about the real patterns that trigger IRS audits? Here's what I've learned after defending thousands of audits. Success with the IRS isn't about minimizing deductions. It's about making your return look as normal as possible for your income level. I've seen clients save thousands in audit costs just by understanding how to structure their legitimate deductions in a way that doesn't raise red flags. Most successful taxpayers I work with don't just focus on maximizing deductions. They master the art of making their returns look consistent and reasonable. And perhaps most importantly, they understand that having good documentation isn't enough. You need to know how to present it in a way that satisfies IRS scrutiny. The real winners know that avoiding an audit is better than winning one. After helping thousands of clients navigate IRS audits, I've learned that the best defense isn't about hiding anything. It's about understanding how the IRS thinks and making informed decisions before you file. Whether you're self-employed or earning W-2 income, success comes down to knowing the patterns that trigger IRS attention. Hit subscribe because next week, I'm sharing my complete audit defense strategy that shows you exactly how to document everything properly. Plus, I'll reveal the one form most CPAs fill out incorrectly that almost guarantees an audit. See you in the next video.